You check your bank account on Friday morning. Payday is supposed to hit sometime today. Rent is due. Your phone bill is already pending. There's $18.42 in checking. And you do that little mental calculation that millions of people know way too well. Okay, if the paycheck lands before the phone bill clears, I'm fine. If the phone bill clears first, I'm dead. Not literally dead, just financially slapped by a computer before breakfast. So you refresh the app. Still $18.42. You refresh again. Still $18.42. Then your phone bill hits. Your account goes negative by $23, and the bank charges you a $35 overdraft fee, which is kind of amazing when you think about it. You didn't have $23, so the bank decided the solution was to charge you another $35. Now you're negative $58. And because your account is negative, the next transaction might trigger another fee. And because the account is negative, you might have to move money, borrow money, skip something, or wait for your paycheck to arrive already wounded. That is the trap. The poorer you are, the more expensive your bank account can become. Not because you use more banking services, not because you're getting premium treatment, not because a tiny banker runs out of a vault with a silver tray and says, "Here is your luxury overdraft experience." Because the entire system is built around one brutal assumption. If you don't have a cushion, every small mistake becomes billable. And this is not just a feeling. According to the CFPB, banks reported $5.83 billion in overdraft and non-sufficient funds revenue in 2023. That was down more than 50% from 2019, which is real progress, but let's not miss the point. Even after major reforms, billions of dollars were still collected from people who, by definition, did not have enough money in the account at the moment the fee hit. And the Federal Reserve found that in 2024, 37% of adults would not cover a $400 emergency expense completely with cash or its equivalent. So when people say, "Just keep a bigger cushion in your account," that advice is technically correct, and completely useless to the person whose entire problem is not having a cushion. Saying, "Just keep more money in your account" to someone getting overdraft fees is like telling someone drowning to simply be more above water. My name is Nick, and I spend way too much time thinking about how banks turn financial instability into fee income. If you're someone who has ever looked at your account balance and thought, "Please just let the paycheck clear before the bill hits," make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today we're talking about how banks charge poor customers more for being poor, not metaphorically, mathematically. And by the end of this video, I want you to see bank fees differently. Not as random annoyances, not as personal failures, not as "I should have known better," but as a system where the customer with the least margin often pays the highest effective price. Here's the thing. Most people think banking is basically free. You open a checking account, you get a debit card, you direct deposit your paycheck, you pay bills, maybe you use an ATM, and if you behave responsibly, the account doesn't really cost anything. That's the story. But that story only works if you have enough money to avoid the traps. Because for middle-class customers with a steady paycheck, a direct deposit, a minimum balance, a credit card backup, and a savings account connected to checking, banking can feel almost invisible. The paycheck lands, the bills clear, the account never gets close to zero, the monthly fee is waived, the ATM fee is avoided, the overdraft never happens. The system feels smooth. But for someone living paycheck to paycheck, the exact same bank account becomes a minefield. Not because that person is using a different product, because they are using the same product without a financial shock absorber. A checking account rewards cushion and punishes volatility. And poverty is volatility. If your money arrives on Friday and your bill hits on Thursday, the bank doesn't care that the money is coming. The system only sees that the money is not there right now. And right now is where the fees live. Now you might be thinking, "Nick, come on, banks have costs. They can't just let people overdraft for free." And look, yes, banks are not charities. Payment systems cost money. Fraud prevention costs money. Accounts cost money to maintain. And if a bank covers a transaction when you don't have enough money, that can be described as a short-term advance. But here's what most people don't realize. A fee can be technically disclosed and still be economically absurd. The CFPB once calculated that if a consumer borrowed $24 for 3 days and paid a median overdraft fee of $34, that would be equivalent to a 17,000% APR. 17,000%. That is not a typo. That is what happens when a small shortfall gets converted into a flat fee. So yes, the bank may say, "We covered your transaction." But if you were short $24 and they charged you $34, they didn't just provide a service. They turned being short into a high-cost loan with a cute banking name. If a payday lender charged that same price, people would call it predatory. When a bank does it, it becomes overdraft protection. Funny little costume change. And this is where it gets really interesting. The fee is not proportional to the mistake. If a wealthy customer accidentally overdraws by $24, they might never feel it because the account is linked to savings or a credit line. If a struggling customer overdraws by $24, they might pay $34 or $35. Same mistake, different price. That is how poverty gets more expensive. Let's make this concrete. Imagine two customers. Customer A has $8,000 in checking, $20,000 in savings, a credit card with a $15,000 limit and automatic transfers turned on. Customer B has $42 in checking, no savings cushion, no credit card, and 3 bills scheduled before payday. Both customers have the same $96 utility bill. Customer A's bill clears. Nothing happens. Customer B's bill clears 1 day early. The account goes negative. A $35 overdraft fee hits. Now customer B is not short $54. Customer B is short $89. Then a $12 subscription hits. Another fee. Now the problem is not $12. The problem is $47. This is the trap. The bank doesn't charge you based on how much help you need. It charges you based on how close to zero you are when the system checks. The same bank account can be free for the person with money and expensive for the person without it. That is the poverty penalty in one sentence. That is why overdraft fees are so psychologically painful. They don't just take money, they punish timing. You can be 1 day away from payday and still get hit. You can have money coming and still get hit. You can be financially responsible in the long run and still get hit because the order of transactions didn't line up perfectly. And when you're poor, timing is everything. A middle-class budget is often about totals. A paycheck-to-paycheck budget is about sequence. This bill before that deposit. This deposit before that auto pay. This debit card hold before that rent check. This grocery charge after the paycheck, not before. People who have never lived close to zero often underestimate how much mental energy this takes. They think budgeting means, do I make enough this month? But for a lot of people, budgeting means, can I survive Tuesday? And banks monetize Tuesday. Here's what most people don't realize. Overdraft is not the only way banks charge poor customers more. It is just the loudest one. Overdraft is the alarm bell, but there is an entire fee machine behind it. There are monthly maintenance fees if you don't keep a minimum balance. There are fees if you can't set up direct deposit. There are out-of-network ATM fees if your bank doesn't have branches near you. There are paper statement fees. There are deposit holds that make your money technically yours but not usable yet. There are account closure risks if your balance stays negative. There are check cashing fees if you don't have an account at all. There are prepaid card fees if traditional banks won't serve you or you don't trust them. There are money order fees if you need to pay rent without a checking account. And there are alternative financial services, payday loans, pawn shops, title loans, rent-to-own products that often become the backup system when mainstream banking fails or feels unsafe. The FDIC's 2023 survey found that 4.2% of U.S. households, about 5.6 million households, were unbanked, meaning no one in the household had a checking or savings account. The same survey found that 14.2% of households, about 19 million households, were underbanked, meaning they had a bank account but still used non-bank financial services like money orders, check cashing, payday loans, pawn shop loans, auto title loans, or similar products. That matters because being outside the banking system is expensive. If you have a bank account and direct deposit, your paycheck just appears. If you don't, you may have to cash a check. That can cost money. If you need to pay a bill, you may need a money order. That can cost money. If you need to send money, that can cost money. If you need short-term credit, that can cost a lot of money. So the trap is brutal. Banking can be expensive when you're broke, but not banking can be even more expensive. That is the poverty penalty. You pay more to access your own money. Now, someone watching this might say, well, if people don't want fees, they should just choose a better bank. And honestly, sometimes that's true. There are better accounts, there are credit unions, there are online banks, there are accounts with no overdraft fees and no monthly maintenance fees. Switching can save real money. But that answer is too simple, because people don't always choose banks like they're comparing headphones online. They choose based on access, location, trust, job requirements, language, documentation, cash needs, branch availability, past account history, and whether the bank will even approve them. The FDIC found that among unbanked households, the most commonly cited main reason for not having an account was not having enough money to meet minimum balance requirements. The second most cited main reason was not trusting banks. That should tell us something. People are not just avoiding banks because they forgot banks exist. Some people avoid banks because the product feels like a trap. Imagine you only have $200 between you and disaster. You open an account, then you get hit with a monthly fee because your balance is too low. Then a deposit hold means your money isn't available when you need it. Then an overdraft fee hits, then another fee hits, then the account gets closed. Then you end up in a database that can make opening another account harder. At that point, I don't trust banks is not irrational. It is based on experience. Trust is hard to build when your first lesson in banking is, we charged you because you didn't have enough money. This is the part where a lot of personal finance advice gets lazy. It says, just use a bank. But the deeper question is, what kind of bank account is safe for someone who has unstable income, irregular bills, low balance, no cushion, and maybe past account problems? Because if the account is designed for stability, it punishes instability. And poor people often don't have unstable finances because they are irresponsible. They have unstable finances because life is unstable at low income. Hours get cut. Tips vary. Gig payments arrive late. Child support is inconsistent. Benefits arrive monthly, but expenses happen weekly. A car repair hits before payday. A utility bill is higher than expected. A deposit clears later than the app suggested. A gas station places a hold. A landlord cashes a check at the worst possible moment. And every timing mismatch can become a fee. Let's talk about the math of one bad week. Say you work hourly and bring home $2,800 a month. Your rent is $1,250. Car insurance is $140. Phone is $65. Utilities are $180. Groceries are $450. Gas is $220. Minimum credit card payments are $150. That leaves $345 for everything else. Laundry, medicine, school stuff, a birthday gift, a parking ticket, a tire, life. Now imagine your account balance is $60 on Wednesday. Payday is Friday. A $75 insurance auto pay hits Wednesday night. You go negative by $15. Overdraft fee, $35. Now you're negative $50. Thursday morning, a $9.99 streaming subscription hits. Another overdraft fee. Now you're negative $94.99. Thursday afternoon, you buy $18 of gas because you need to get to work. Another fee. Now your $18 gas costs $53. By Friday, before your paycheck even arrives, you may have lost $105 in fees. That is not a budgeting lesson. That is a cash flow ambush. And the worst part is what happens next. Your paycheck lands, but it doesn't feel like payday because the first $105 is already gone. Now you have less money for rent, groceries, or the next bill. So the fee that punished last week creates the shortage that causes next week's fee. That is the cycle. Fee, shortage, fee, shortage, fee. And once you are in that cycle, people start making decisions that look irrational from the outside but make perfect sense from the inside. They delay paying a bill. They use a payday loan. They borrow from a family member. They turn off auto pay even if it risks a late fee, because at least a late fee may come later than an overdraft fee today. They cash a check instead of depositing it because they need the money now, not after a hold. They keep cash at home because the bank account feels dangerous. And then someone with a spreadsheet says, why don't poor people just make better financial choices? Because the choices are being made inside a system where every option has a trap door. This is where it gets really interesting. A bank fee is not just a fee. It changes how people think. When you have money, automation feels convenient. Auto pay your bills. Auto transfer to savings. Auto invest. Auto everything. Automation is wonderful when the account has a cushion, but when you're living near zero, automation becomes terrifying because you don't control the exact moment the system takes the money. So people turn off auto pay. Then they miss due dates. Then they get late fees. Then their credit score gets hit. Then borrowing gets more expensive. Then insurance may get more expensive. Then renting may get harder. One $35 fee can be the first domino in a chain that costs hundreds or thousands. And no, every overdraft fee does not destroy someone's life. But if you live close to the edge, fees don't need to destroy you. They just need to keep you from climbing. Here's another layer. Banks often waive fees for customers who already have money. Keep a $1,500 minimum balance? No monthly fee. Set up direct deposit above a certain amount? No monthly fee. Maintain a relationship balance across accounts? No fee. Have a premium account? Free checks, free wires, better service, ATM rebates. In other words, the more money you have, the cheaper banking gets. The less money you have, the more likely you are to pay for basic access. This is the reverse discount. We're used to bulk discounts. Buy more, pay less. But in banking, the discount is often not just for buying more. It's for having more. If you can afford to leave $1,500 sitting in checking, the bank may waive your $12 monthly fee. If you cannot afford to leave $1,500 sitting in checking, you pay $12. That $12 may not sound like a lot, but $12 a month is $144 a year. Add one overdraft fee, $179. Add two out-of-network ATM fees a month at $3 each, another $72. Now you're over $250 a year just for being in the wrong balance range. And that's the conservative version. The money that could become your cushion gets taken because you don't already have a cushion. That is how the system eats its own solution. For someone living paycheck to paycheck, $250 is not nothing. That's groceries, that's utilities, that's part of a car repair. That's the emergency cushion that might have prevented the next overdraft. Now, some banks have changed, and we should say that clearly. Many large banks reduced or eliminated NSF fees. Some reduced overdraft fees. Some added grace periods. Some no longer charge overdraft fees on small negative balances. The CFPB reported that the vast majority of NSF fee revenue has been eliminated, saving consumers nearly $2 billion annually, and that overdraft and NSF revenue fell from nearly $12 billion in 2019 to $5.83 billion in 2023. That is real progress. But progress is not the same as solved, because $5.83 billion is still $5.83 billion. And the customers most exposed to those fees are not usually the customers with the most financial power. Also, the regulatory story got messier. The CFPB finalized a rule in December 2024 that would have capped certain overdraft fees at $5, or required banks to justify higher costs, or treat overdraft like credit with additional disclosures. But Congress later overturned that rule under the Congressional Review Act before it took effect. So the future of overdraft fees is not just about consumer choice. It is also about policy and lobbying. And what regulators decide counts as a fee versus a loan. Because let's be honest, if a payday lender charges you $35 to borrow $24 for 3 days, everyone understands that as expensive credit. If a bank does it, it gets called overdraft. Same basic math, different costume. Now you might be thinking, but overdraft can help people. If your rent check would bounce, maybe paying a fee is better than getting evicted. That's a fair point. Sometimes overdraft is the least bad option. If the bank covers an emergency transaction and prevents a bigger problem, that can be useful. If a $35 fee prevents a $75 late fee or keeps your electricity on, you might choose it. The issue is not whether short-term liquidity has value. The issue is whether the price is fair, clear, and designed to help the customer escape the cycle instead of stay inside it. A bridge is useful. A bridge with a toll booth every 3 feet is a business model. That's the difference. Overdraft should function like a safety valve. But for years, at many institutions, it functioned like a revenue stream. And revenue streams are very hard to give up. Here's what most people don't realize. The bank's incentives are not the same for every customer. A wealthy customer may generate profit through deposits, investments, mortgages, credit cards, brokerage accounts, business accounts, and long-term relationship value. A low-income customer may generate less deposit value and may require more customer service, more cash access, more branch use, more transaction management. So the bank may rely more on fees to make the account profitable. That does not mean every bank employee is sitting there plotting against poor people. Most frontline bank employees are just doing their jobs. The issue is product design. If your account only becomes free when you maintain a balance you cannot maintain, then the account is not designed around your reality. It is designed around someone else's. And then your failure to fit the product becomes the bank's fee income. Let's talk about another hidden cost: bank access. If you live in a neighborhood with lots of bank branches and free ATMs, withdrawing cash is simple. If you don't, every cash need can cost money. Out-of-network ATM fee from the ATM operator. Out-of-network ATM fee from your bank. Maybe $3 here, $3 there. Again, tiny amounts. But the whole video is about tiny amounts that become a system. If you withdraw cash twice a month and pay $6 total each time across both fees, that's $12 a month, $144 a year. And if you need cash because your landlord, local store, babysitter, or family arrangement runs on cash, just don't use cash may not be realistic. This is why advice often fails. It assumes the financial world is smooth. But for lower-income customers, the financial world has friction everywhere. Deposit holds, minimum balances, ATM geography, account approval systems, auto-pay timing, overdraft settings, replacement card fees, money orders, check cashing, late fees, reconnect fees. Every friction point has a price. And if you have money, you glide over it. If you don't, you pay the toll. Now let me tell you a story. Let's call her Tanya. Tanya is 29. She works at a nursing home and picks up extra shifts when she can. Her monthly take-home pay is usually around $2,900, but it changes depending on hours. She has a checking account at a large bank because that's where her employer encouraged direct deposit. She is not reckless. She is not buying yachts. She is not day trading meme stocks while eating caviar in a rented Lamborghini. She is trying to keep her kid fed, her car running, and her rent paid. 1 month, her hours drop because the facility cuts shifts. Her paycheck is $360 lower than normal. Rent still costs the same. Utilities still cost the same. Her car still needs gas. She pays rent. Then the electric bill hits. Then her kid needs medicine. Then her bank account goes negative by $14 after a grocery run. Overdraft fee, $35. 2 days later, a second small transaction posts. Another fee. Now she's negative $84 before payday. When the paycheck arrives, it gets swallowed immediately. She tells herself, okay, next month I'll catch up. But next month starts $84 behind. And because she's behind, she delays the phone bill. Late fee. Then she pays the phone bill with a debit card. The timing is off. Another overdraft. Now she turns off autopay because she's scared of surprise withdrawals. But without autopay, she misses a due date. Another fee. At no point did Tanya make one dramatic, irresponsible decision. She was not destroyed by a huge purchase. She was trapped by small timing penalties. The system often takes the people who most need stability and sells them instability at a premium. Then it calls the result personal responsibility. Now let's be practical, because this video is not just here to make you angry. Anger is useful for about 12 minutes. After that, we need a plan. The first step is to know whether your account has overdraft turned on for debit card and ATM transactions. Under federal rules, banks generally need your opt-in before charging overdraft fees for one-time debit card purchases and ATM withdrawals. But that opt-in does not work the same way for checks and automatic ACH payments. So ask your bank, am I opted into overdraft coverage for debit card and ATM transactions? If yes, ask what happens if you opt out. In many cases, the transaction may simply be declined instead of approved with a fee. And honestly, for a lot of people, embarrassment at the checkout is cheaper than a $35 fee. Not fun, but cheaper. A declined card feels bad for 30 seconds. A $35 overdraft fee can hurt for a week. Choose the cheaper pain. Second, ask about a low balance alert. Set alerts at amounts that actually matter, not just $0. Set one at $100, set one at $50, set one at $25. Because by the time your account hits zero, the fee may already be on its way. Third, separate bill money from spending money. If possible, use 2 accounts. One for bills, one for debit card spending. When the paycheck hits, move the bill money first. Rent, utilities, insurance, phone, everything scheduled. Then whatever is left goes into spending. This doesn't solve low income, but it reduces timing chaos. And timing chaos is where fees breed. Fourth, avoid using your debit card as a real-time budget if your balance is unstable. I know that sounds weird, but debit cards feel like cash. They are not cash. Gas stations can place holds. Restaurants can adjust tips. Pending transactions can disappear and reappear. The balance you see in the app may not be the balance the system uses after everything settles. If you are close to zero, pending transactions are dangerous. The number in your banking app is not always your real safe-to-spend number. That gap is where fees hide. Fifth, ask your bank if they offer a no overdraft account. Some banks and credit unions offer accounts that simply do not allow overdrafts. No overdraft means no overdraft fee. The transaction declines. Again, not glamorous, but predictable. And predictable beats expensive. Sixth, consider switching institutions. I know switching banks is annoying. It is one of those tasks that sounds simple until you remember your entire life is attached to that account like financial spaghetti. Direct deposit, rent, utilities, subscriptions, car insurance, payment apps. But if your current bank is costing you $200, $400, or $700 a year in fees, switching may be one of the highest return moves you can make. Look for no monthly maintenance fee, no minimum balance requirement, no overdraft fees, free ATM network access, early direct deposit, real-time alerts, free bill pay, a branch or ATM access pattern that matches your life, not someone else's life, your life. Seventh, if you get hit with a fee, ask for a refund. Yes, ask. Call or message the bank and say, I've been charged an overdraft fee. I understand the account went negative, but I'm asking for a courtesy refund. I've brought the account current and I'd like to avoid this happening again. Can you waive this fee? Will it always work? No. But many banks will reverse occasional fees, especially if you ask calmly and specifically. And if they say no, ask, is there any hardship assistance or fee reversal option available? Do not assume the first no is the final no. The bank has a script. You should have one too. Eighth, if the fee came from something unfair or confusing, complain. Start with the bank, then escalate. The CFPB has highlighted unfair overdraft and NSF practices, including situations where consumers were charged unfair, unanticipated overdraft fees or repeated NSF fees on the same transaction, and financial institutions agreed to refund more than $240 million to consumers. After CFPB supervisory work. That does not mean every fee is illegal, but it does mean mistakes and unfair practices happen. If something looks wrong, document it. Screenshot balances. Save transaction histories. Write down dates. Ask for the bank's explanation in writing. Ninth, build a micro buffer before building a full emergency fund. A lot of advice says, save 3 to 6 months of expenses. Great. Also, for someone living paycheck to paycheck, that can sound like saying simply levitate. Start with a $50 buffer, then $100, then $250. The goal is not to feel rich. The goal is to stop the fee machine from touching you. A $100 buffer can prevent a $35 fee. A $250 buffer can prevent multiple fees. A $500 buffer can create breathing room. The first emergency fund is not for emergencies. It is for timing. 10th, treat every recurring charge like a loaded trap if your balance is unstable. Subscriptions, auto renewals, annual fees, trial periods, memberships, app charges. Go through your account and identify every automatic withdrawal. Then ask, does this need to be automatic? Should this be moved to a credit card? Should this be canceled? Should this be scheduled right after payday? Should this be paid manually? Auto pay is not good or bad. It depends on whether it helps you avoid fees or creates them. Now, I want to address one more objection. Some people will say, isn't this just about financial literacy? And yes, financial literacy helps. Understanding overdraft, minimum balance rules, ACH timing, and fees absolutely helps. But we need to be honest. Financial literacy cannot fully solve financial scarcity. You can understand every fee perfectly and still not have enough money. You can make the optimal decision and still get hit by a timing mismatch. You can choose the better account and still live in a system where one missed shift creates a cascade. So the point is not, poor people need to learn banking. The point is, banking products should not be designed so that the people with the least money pay the highest penalties. That is the moral center of this video. Because when banks charge wealthier customers less because they have money, and poorer customers more because they don't, we should stop pretending the system is neutral. It is not neutral. It is calibrated, and the calibration matters. Now, I want to end with the mindset shift. If you have been hit with overdraft fees, maintenance fees, ATM fees, check cashing fees, or account penalties, I don't want you to walk away from this thinking, I'm stupid. That is what the system wants. It wants the fee to feel like shame. But a lot of these fees are not proof that you're bad with money. They are proof that the financial system is most expensive when your margin is smallest. So yes, learn the rules. Yes, set alerts. Yes, switch banks if you can. Yes, opt out of overdraft if that protects you. Yes, build a buffer. Yes, ask for fee refunds. Yes, use credit unions, low-fee accounts, or no minimum accounts when available. But also do not confuse being charged a fee with deserving the fee. Those are not the same thing. The bank already has a system. It has transaction ordering, fee schedules, deposit holds, minimum balance rules, overdraft settings, ATM networks, account screening, call scripts. You need a system too. Your system can be simple. Know your fee schedule, turn on alerts, keep bill money separate, opt out of dangerous overdraft settings, choose accounts with no minimums, ask for refunds, document unfair fees, build the smallest buffer that breaks the cycle. And remember this, the goal is not to become perfect. The goal is to become harder to fee. Because here's the truth. Banks do not charge poor customers more by putting up a sign that says poor customer surcharge. They do it through rules that sound neutral. Minimum balance, overdraft, maintenance fee, ATM fee, deposit hold, account closure, returned item. Each rule may sound reasonable in isolation, but together they create a system where having less money makes money itself more expensive. That is the poverty penalty. And the first step to beating it is naming it. So the next time someone says it's only a $35 fee, remember, for the bank, it's a fee. For the customer, it might be groceries, gas, medicine. The difference between catching up and falling further behind. And if this video helped you understand why banking feels so expensive when you're broke, hit the like button, subscribe for more videos like this, and send this to someone who has ever been charged money for not having enough money. Because they might need to hear this. You are not crazy. You are not imagining it. The system really does get more expensive when you have less. And as always, they didn't write poor customer surcharge on the fee schedule. They just built the fee schedule around not having money. Terms apply.